Every dollar in your wallet is another person's debt. This isn't a metaphor, it's the core design of our financial system. If you save money, it's because somewhere else, someone is in debt. A mortgage, a government bond, a corporate loan. The entire global economy is built on this paradox. Money isn't wealth, it's obligation. But we rarely stop to ask the obvious question, why? Why does money have to mean debt? What if it didn't? What if money could exist without someone being shackled by a promissory note? History shows us it's possible. But to see that clearly, we first need to understand how the current system really works, because most people have no idea. Let's start with banks. Most people imagine banks are like intermediaries. They take deposits from savers and lend that money to borrowers. Simple, right? That's the story we're told. The truth is far more radical. In reality, banks create money when they issue loans. If you borrow $100,000 to buy a house, the bank doesn't pull that money from another customer's account. It types it into existence. Your mortgage creates brand new money. That $100,000 wasn't in the system yesterday, but it is today, with a crucial condition. You owe it back with interest. Multiply that by millions of loans, credit cards and mortgages, and you start to see the scale. Most of the money in circulation was born as debt. Governments do this too. When a government spends more than it collects in taxes, it borrows. It issues bonds, promises to pay back in the future with interest. Investors, banks, or even the central bank itself buy these bonds, and in the process, new money enters the economy. But again, this money is tied to debt. It's an obligation future taxpayers must honor. This means every time your government finances a war, a financial bailout, or a social program through borrowing, it's chaining its citizens to repayment. And here's the core problem. The system only survives if debt keeps growing. If people stop borrowing, the money supply shrinks. If governments stop issuing bonds, the flow of liquidity dries up. Like a shark that must keep swimming to stay alive, the financial system must keep expanding debt or it will collapse. This is why central banks panic when lending slows down, why interest rates are cut to incentivize borrowing, and why inflation is tolerated. The system is addicted to growth, and growth comes from debt. This means inflation is baked in. As more debt creates more money, the value of existing money erodes. It also means inequality widens. Those who lend, banks, investors, wealthy elites, earn interest, while those who borrow, workers, families, small businesses, pay it. And it means true financial freedom is nearly impossible. You can pay off your personal debts, but you can't escape the reality that the money you hold is someone else's liability. Now this is where the story takes a turn. You might think this is just the natural order of things, that money has always worked this way. But history proves otherwise. Debt money isn't a law of nature, it's a design choice. And other designs have existed, some ingenious, some disastrous, but all of them remind us that money doesn't have to mean debt. Look at ancient Mesopotamia, more than 4,000 years ago. Farmers would borrow grain from temples and debts would pile up quickly. Kings realized if these obligations were enforced forever, society would collapse. So they issued debt jubilees, widespread cancellations that wiped the slate clean. It wasn't charity, it was survival. They understood that money as infinite debt would destroy the social fabric. Or consider medieval England. For centuries, the crown used tally sticks, simple wooden sticks split down the middle with notches carved in to record values owed. Half went to the crown, the other to the taxpayer. These weren't debts in the modern sense. They were records of obligations, but they didn't bear interest. They weren't traps. They functioned as money for over 500 years, circulating as a trusted medium of exchange. A medieval kingdom ran on pieces of wood, and it worked for longer than many modern banking systems have lasted. Then there was commodity money, gold and silver coins. Their value was in the metal itself, not in someone's promissory note. A pure silver coin had value regardless of government backing. This provided stability, but at a cost. When mines flooded Europe with new silver in the 16th century, inflation soared. When supplies dried up, economies stagnated. Commodity money was honest, but inflexible. Even in modern times, states have experimented with alternatives. During the American Civil War, President Abraham Lincoln introduced greenbacks, paper money issued directly by the U.S. Treasury. Here's the key difference. Unlike today's dollars, which are created when banks lend or governments issue bonds, greenbacks were printed as money itself, with no debt attached. They were legal tender for taxes and trade. For a time they worked, soldiers were paid, suppliers were funded, and the war effort continued. But after the war, bankers lobbied to shut them down. Why? Because debt money pays interest, and greenbacks didn't. Directly issued government money was a threat to financial elites. Of course, not every experiment succeeded. In revolutionary France, the government issued assignats, paper money backed by confiscated church lands. At first, they stabilized the economy, but when politicians overprinted them, confidence collapsed. By 1795, assignats were nearly worthless. The failure wasn't the impossibility of debt-free money. The failure was that without discipline, any currency, debt-based or not, can die. What these stories prove is simple but powerful. Money is not fixed. It's not a law of physics. It's a design, and debt is only one possible design. If the past shows us money can be designed differently, the present offers living examples. They may not dominate the headlines, but they prove that alternatives to debt-based money aren't just historical curiosities. They exist right now. Look at Switzerland in the 1930s. During the Great Depression, banks were failing and credit had dried up. Small businesses had goods to trade and services to offer, but no cash to exchange them. Out of necessity, they created the WIR Bank. It wasn't a normal bank. Instead of lending out francs for interest, it allowed businesses to trade with one another using a mutual credit system. A carpenter could buy supplies with WIR credits, and a baker could pay for repairs the same way. No debt, no compounding interest, just trust, recorded in a ledger. And here's the key. Credit isn't the same as debt. Credit is simply the extension of trust, a record of exchange. Debt is when that trust is weaponized with interest and obligations. The WIR Bank still exists today, with tens of thousands of businesses using it to stabilize trade during downturns. It's proof that credit doesn't have to be debt, and money doesn't have to shackle people to banks. Then look at local currencies. The Bristol pound in the UK, the Berkshires in Massachusetts. These are issued not by central banks, but by communities. A Bristol pound is worth one national pound, but it can only be spent locally. This design keeps wealth circulating within the community instead of leaking out to global corporations or financial markets. It doesn't completely free people from the debt-driven grind of national currencies. But it demonstrates that money can be designed to serve communities, not just creditors. And then there's the radical outsider, cryptocurrency. Bitcoin was born in 2009, amidst the wreckage of the global financial crisis as a direct challenge to central banks and bailouts. Its creator, hidden under the name Satoshi Nakamoto, built it to be everything the current system is not: finite in supply, independent of governments, and not tied to debt issuance. New bitcoins are created through mining, and the supply is capped at 21 million. For its supporters, this is liberation. Money no central bank can inflate and no government can devalue. For its critics, it's volatile, speculative, and vulnerable to manipulation by large players. Still, it proves a crucial point. You can have money that isn't born as debt. Money created by code and consensus instead of loans and bonds. Even governments themselves are experimenting with alternatives through central bank digital currencies, or CBDCs. At first glance, you might think this is no different from what we already have. After all, don't central banks issue money today? Yes and no. Central banks issue the base layer of money, the cash in your wallet and the reserves commercial banks hold with them. But the vast majority of money, over 90% in most economies, is created by commercial banks when they issue loans. That's the fractional reserve system at work. When you see money in your checking account, it's not central bank money. It's bank-created money, born as debt. A CBDC would invert that architecture. Instead of relying on commercial banks to create deposits, the central bank could issue money directly to citizens. Imagine having a digital wallet at the Federal Reserve or the European Central Bank, where your money is not a bank's liability, but instead direct central bank money. This could strip private banks of their monopoly on money creation. But here's the tension. While CBDCs could weaken the grip of debt-based money, they could also vastly increase state control. Every transaction could be monitored. Money could even be programmed, designed to expire or restricted to certain uses. A project meant to free us from the power of private banks could instead enslave us to the state. There's also the idea of resource-backed money. For centuries, gold and silver played this role. Today, some propose tying money not to metals or to debt, but to real resources. Imagine a currency pegged to energy. 1 kilowatt-hour equals 1 credit, or a carbon currency, where each unit represents the right to emit a fixed amount of carbon dioxide. If that sounds like carbon credits, you're right. But the idea goes further. Instead of being a niche market tool, carbon would become the foundation of the monetary system, like gold once was. Your salary would represent slices of the planet's carbon budget. The benefit is discipline. Governments couldn't print money without limits because emissions are finite. The risk is obvious. Tying money to environmental limits could mean harsh rationing and immense political control. Still, it's proof that we don't have to accept debt as money's anchor. We could tie it to trust, to communities, to code, or to the planet's resources. What ties all these examples together, from the WIR to Bitcoin and carbon currency, is the reminder that money isn't inevitable. It's a choice. Our debt-based system dominates not because it's the only way, but because it's the most profitable way for those in power. Banks earn billions in interest. Governments can spend without raising taxes. Elites accumulate wealth, while ordinary people accumulate obligations. Debt money concentrates power upward by design. And yet, throughout history and the present, people keep proving that alternatives are possible. Money can be credit without chains, resources without promissory notes, or government issued without debt. Each model has strengths and weaknesses, but the point is clear. Debt money isn't destiny. So, why does all this matter today? Because the cracks in the debt-based system are widening. Global debt is at record highs, over $300 trillion and climbing. Governments borrow ceaselessly to fix fiscal holes. Families juggle mortgages, student loans, and credit cards that never seem to get lighter. Inflation erodes wages, turning savings to dust. And every so often, when the system stumbles, the solution is the same: more debt. Central banks cut rates, print trillions, and governments issue bonds to bail out banks or corporations. Each rescue just deepens the grind. This isn't just abstract economics, it's personal. Your mortgage, your taxes, your paycheck are all products of a system that only works if you and millions like you stay in debt. Even when you're not borrowing, the system is. Your government issues bonds on your behalf. Your bank uses your deposits to multiply loans. The money you hold in your account isn't wealth, it's someone else's obligation, and that obligation keeps expanding. But here's the hopeful truth. It doesn't have to be this way. Debt money isn't natural law, it isn't gravity, it's design, and design can be changed. The kings of Mesopotamia cancelled debts when they threatened social collapse. Medieval England ran for centuries on tally sticks. The United States fought a civil war using debt-free greenbacks. Today's communities use local currencies to insulate themselves from global shocks. Switzerland has a mutual credit bank that has survived for 90 years. Even Bitcoin, for all its flaws, proves money can be created outside the debt machine. The lesson isn't that one system is perfect. Everyone has strengths and weaknesses. Gold is stable but rigid. Local currencies build resilience but struggle to scale. Cryptocurrencies promise freedom but bring volatility. CBDCs could bypass banks but risk state surveillance. Carbon-backed money could tie value to real limits but concentrate political control. The point isn't to romanticize alternatives. The point is to remember that alternatives exist and that the system we live in today isn't inevitable. So what should we learn? First, understand the mechanics. Know that most of the money you touch was born as debt through loans and bonds. Recognize that inflation, inequality, and financial crises aren't accidents. They are features of this design. Second, see money as a tool, not a law of nature. It can serve people or creditors. It can anchor communities or enrich elites. And third, don't mistake access for security. Just because the system is running smoothly today doesn't mean it always will. History shows us how fast trust can collapse, how easily currencies can be devalued, and how devastating it is when money stops flowing. True financial education means asking the hard questions. If the rails I rely on suddenly break, do I still stand? If inflation erodes my paper wealth, do I hold assets that retain value? If the debt treadmill speeds up, do I know how to step off? Money doesn't have to mean debt. It can mean trust, it can mean resources, it can mean freedom, but only if we imagine and demand it. History doesn't repeat, but it rhymes. And the rhyme here is clear. Every civilization that tied money too tightly to debt eventually collapsed under the weight. The survivors were those who remembered that money is just a design, and designs can be remade. If this gave you a new perspective, click subscribe. History holds the answers. I'll show you where to look.